Hello everyone, and you're welcome once again back to LearnCity. In today's class, we are going to talk about investment strategy. Investment strategies is also known as buy and hold. In this session, we will explore the fundamentals of this time-tested approach to investing in the financial markets. The buy and hold strategy is widely practiced by seasoned investors and has proven to be a successful long-term investment strategy. And by the end of this lecture, you will be able to have a comprehensive understanding of how buy and hold works, the advantages and the disadvantages. You will be acquainted with it and why it continues to be a popular choice for many investors. I haven't talked about all those things that we are going to encounter in this course. Let's talk about the basic understanding of buy and hold. Let's go to the definition of buy and hold. Buy and hold is an investment strategy where an investor buys financial assets such as stocks, bonds, or mutual funds, and they hold onto them for an extended period, usually several years or even decades. Unlike active trading strategies that involves frequent buying and selling of assets, the buy and hold investors remain committed to their their particular investments, which allow them to weather short-term market of fluctuations. Since we've known the meaning and definition of buy and hold, let's go to the certain key elements of buy and hold. Number one key element is long-term perspective. For buy and hold investments, they focus on the long-term performance of their investments rather than their short-term price fluctuations. They believe in the potential growth of their assets over time rather than the short-term period for their assets. So let's go to the second one, which is diversification. Diversification, a critical aspect of buy and hold, is diversifying the investment portfolio, thereby spreading investments across different asset classes, which helps to reduce risk and potential losses. That's that about second one. Let's go to the third one, which is the reinvestment. As dividend or interest payments are earned, buy and hold investors often reinvest these earnings back into their existing holdings, compounding their interest over time rather than being in a static form. Having known the meaning of buy and hold, we've talked about the definition. Let's go to how buy and hold works. Let's go to number one, how it works, which is the power of time. One of the core principles behind buy and hold is the power of time in the financial market. Over the long run, the stock market has historically shown an upward trend despite short-term fluctuations. By staying invested for an extended period rather than short period, particular investors or individual investors can benefit from the overall growth of the markets they invested in. Number two is capitalizing on compounding buy and hold investors. Investors leverage the concept of compounding to their advantage. That is, the compounding refers to the process of earning returns not only to the initial investment but also on the accumulated earnings over time. This exponential growth can significantly enhance the overall returns on an investment. The third one to go into is ignoring market timing. Ignoring market timing. The term market timing refers to the attempt to predict the times to buy or sell assets based on short-term market movement themselves in the process of buying and hold. They do not engage in market timing as it is notoriously difficult to consistently predict market movement, but instead they trust in the long-term growth potential of their investments.